And I'm happy to have Tyler Mondres from the ABA, hopefully I get everybody's name right. I'm trying my best here. Sanjay Patnaik from the Center on Regulation and Markets from Brookings. I have Amber Busby back from US Bank. Jamie Woodwell from the Mortgage Bankers Association, and we have virtually joining us Nicholas Verone from the Peterson Institute for International Economics, and there I can see him online, perfect. So I'm going to go ahead and open it up and start with Tyler and let you all get started here with everybody getting their 5 minutes.
Thank you so much, and thank you for the opportunity to provide additional input today as part of the agency's decennial review under the Economic Growth and Regulatory Paperwork Reduction Act. The American Bankers Association represents banks of all sizes and business models across the country. The industry is committed to a strong, safe, and fair financial system. However, the regulatory framework has accumulated decades of complexity, overlaps, and outdated requirements. EGRPRA exists to identify these burdens that no longer align with supervisory objectives and to ensure regulation keeps pace with modern banking. My remarks today highlight 4 broad themes. First, the need to modernize outdated operational regulations. 2, improving the capital framework, briefly touching on CRA, and reducing burden through better process clarity and indexing. So on banking operations, a number of core operational rules written decades ago no longer reflect how banks or consumers transact today. For example, aspects of Reg II go beyond statutory intent and impose substantial technical and contractual burdens, particularly following the 2022 routing and exclusivity amendments. Requirements to enable multiple networks across transaction types have created uncertainty, significant operational expense, and in some cases mandated the use of networks with unproven fraud prevention capabilities. These requirements deserve reconsideration. We also encourage the agencies to modernize Reg CC's funds availability framework to reflect today's fraud landscape, working with Congress as needed. This includes expanding reasonable cause holds, considering a defined fraud exception, revisiting the definition of a new account, and ensuring hold times allow banks to prevent increasingly sophisticated check fraud. Additionally, Reg CC continues to reference outdated concepts like non-local checks, even though the Federal Reserve consolidated check processing years ago. Turning to capital, ABA strongly supports standards that are rigorous, risk-sensitive, and transparent. However, several elements of the existing framework have drifted from those principles. Leverage ratios, for example, were designed to serve as a backstop, not a binding constraint. Yet in practice, they increasingly discourage low-risk activities such as holding reserves or facilitating flight-to-safety flows. We urge the agencies to continue recalibrating these standards, including through the exclusion of low-risk assets. In stress testing, banks often face double counting of the same risks across capital rules and buffers, greater transparency in model assumptions, more realistic treatment of trading revenue, and recalibration of the
Yeah.
Our mics are down.
Oh, this one works now as well. All right, there we go. Greater transparency in model assumptions, more realistic treatments of trading revenue, and recalibration of the global market shock and large counterparty default components would lead to a more coherent framework. We welcome the Fed's recent efforts to provide additional transparency and opportunities for public feedback to this process. We also encourage agencies to address double counting where it appears elsewhere in the capital framework. For example, the non-significant investment threshold, which seeks to address interconnectedness risk, is duplicative of post-crisis reforms such as the GSIB buffer and single counterparty credit limits. We likewise encourage the agencies to eliminate unnecessary gold plating relative to international standards across capital rules and ensure U.S. rules reflect actual economic risk rather than mechanical or outdated metrics. I am now a robot on the mic, so you've all outed me. I'm a lazy person. We appreciate the agency's efforts to acknowledge some of these shortcomings in the recent batch of capital proposals and look forward to commenting in more depth as we review the details more closely. Very briefly on CRA, with the agencies in the process of rescinding the 2023 CRA rule, we urge using this moment to preserve the strengths of the 1995 framework while maintaining. I don't know who I angered.
You want to try using hand mics?
Keep that handy. Keep it handy, Dan. Thank you. Here, I'll hold on to it. I need to run this. Thank you.
The 1995 framework, I'll just use this guy over here. Testing? All right, there we go, that sounds good. With the agencies in the process of rescinding the 2023 CRA rule, we urge using this moment to preserve the strengths of the 1995 framework while making practical updates informed by nearly 30 years of implementation experience to ensure CRA's incentives are aligned with actual community needs and modern business models. Lastly, many sources of burden are not tied to individual rules, but rather to regulatory process and fragmentation. Banks often face inconsistent interpretations across examiners or agencies, informal guidance that isn't publicly available, and misalignment among parallel reporting regimes. For example, in small business data collection under both the CRA, the call report, and the CFPB's 1071 rule. The agencies can significantly reduce burden by improving transparency, harmonizing reporting requirements where possible, and updating interagency Q&A and examination procedures to clarify expectations. And finally, one of the most impactful and straightforward reforms is indexing regulatory thresholds. When thresholds remain fixed, they gradually capture banks they were never meant to cover, distort growth incentives, and dilute supervisory resources. Linking thresholds to nominal GDP after an initial one-time adjustment would help to keep regulations appropriately tailored over time. These recommendations reflect input from institutions of all sizes and a shared desire for a regulatory framework that is risk-focused, transparent, and durable. Thank you for the opportunity to share our views. We look forward to continued dialogue as this review moves forward.
Thank you. Thank you for, okay, so that. Go ahead, Sanjay.
Of course, thank you so much, everyone. My name is Sanjay Patnaik. I'm the director of the Center on Regulation Markets at Brookings, and thanks for the opportunity to speak here today. We think a lot about how to find the right balance between not over-regulating and regulating sufficiently to correct market failures and reduce material risks. And this question has become much more important in recent years in light of technological advances that have led to a faster-paced market environment and more rapidly occurring market changes. When we look at this review here today that we are a part of, and the broader regulatory landscape, we can observe that over the last 25 years or so, the US really has moved towards a system where a lot of policy gets made through regulatory action and executive agencies. And so that means there is a growing body of rules and regulations, as many of my previous panelists have noted, that often impose overlapping requirements. And so policymakers have and regulators have a lot of different tools available to modify those regulations. They are all within very well-established mechanisms where you can revisit, modify, or where appropriate, remove existing rules. Some examples, as many of you know, include formal rulemaking under the Administrative Procedure Act or congressional tools such as the Congressional Review Act. But more recently, we also see many more actions that focus on delaying certain regulations or where the agencies try to revisit and rescind regulations. Each of these tools give regulators and policymakers a way to adjust the regulatory framework and the regulatory frameworks to fast market conditions. But the key challenge here is to really use them judiciously, preserving core protections while trying to improve the efficiency of the system and coherence, especially across different regulators. As all of you know, we have financial market regulation to correct existing market failures and, like information asymmetries, for instance, and to reduce material risks. What is important, though, is that this regulation is not costless. And so these regulations often have increasing costs on a wide range of institutions. And these are increasingly also a central concern for the markets, for the financial market participants, but also for policymakers. And what is important is that these cost burdens are not evenly distributed. When we look at empirical evidence, and my colleague Aaron Klein in my center has done a lot of work in this space, evidence consistently shows that compliance costs are almost like fixed overhead. That meaning they fall disproportionately on smaller institutions. I can give you a couple of examples. For instance, community banks devote significantly higher shares of the personnel and operational budgets to compliance than large banks, in some cases spending over 11 to 15% of payroll on compliance functions compared to 6 to 10% at larger institutions. And this matters because community banks play a critical role in relationship lending, small business finance, and rural economies. And so when compliance costs rise, those costs are often passed through to customers through reduced credit availability or higher prices. And so when we look over the years, we see that regulation accumulates as new rules are being layered on top of existing rules. And this leads to an increasingly complex system that financial institutions have to navigate. Often these rules are being put in place without systematically revisiting whether those earlier requirements still make sense. And this can lead to what we call regulatory accumulation. Basically overlapping rules, outdated thresholds, and duplicative reporting requirements that can impose real burdens on institutions without always delivering on the public benefits that we want regulations to have. So retrospective reviews such as the one within the EGRPRA are really important because they make regulations and rulemaking more dynamic. 10 years is still a very long time frame, and my guess is looking to the future, we probably will have to think about maybe shortening that time frame as AI changes our markets much faster than we're used to. And so I wanted to bring up two important ideas here. One is, one thing that could be quite interesting for regulators to think about is the imposition of a regulatory budget. We have seen some really interesting experimentation across states and also in provinces in Canada where regulatory agencies use a regulatory budget where they limit the number of rules or a number of new rules and also the impact of them by revisiting a lot of the old ones and making sure that you don't have that overgrowth of regulation that accumulates over time. And so I think there's really interesting empirical evidence out there what this could do for regulations. And the second one is to really take a very close look at how you can change some of those regulatory burdens or adjust them by just looking at how different regulations are being implemented across agencies. Oftentimes the implementation varies significantly, and those are kind of like low-hanging fruit where you could harmonize implementation across agencies and maybe make sure that the institutions that are being regulated face kind of like a more unified regulatory front. And so just as a concluding thought, we call it in our center, we call it smart regulation. The goal basically is to provide a framework that continues to safeguard financial stability and protect consumers, but reduces unnecessary costs and kind of like targets real risk and material risk in a better way. Thank you.
Thank you, Sanjay. Amber, it's over to you.
Good afternoon. I'm Amber Beck at U.S. Bank. It's a privilege to be here today on behalf of the bank. And as a company, we would like to extend our sincere thanks to the staff at the Federal Reserve, their sister agencies, the OCC, the FDIC, and many of the trade associations and others that are here today participating in this constructive dialogue around shaping bank regulation. In October of last year, we partnered with 3 of our peers, PNC, Capital One, and Truist, to submit a joint comment letter in response to an interagency EGRPRA solicitation. Together, we made policy recommendations largely centered on capital and tailoring, using this opportunity to share our unique perspective as Category 3 banking organizations that are approaching Category 2. We appreciate your consideration of our and other stakeholder suggestions and the incorporation of many of these suggestions into the Basel III capital modernization proposals that were published last week. We are particularly supportive of the proposal's treatment of mortgages and mortgage servicing. We are also encouraged by the continued discussion on tailoring and indexing regulatory frameworks, which will right-size our regulatory system, creating a durable environment that reflects economic growth. Additionally, we appreciate the continued ongoing work of the agencies individually and through the interagency process to review regulations and ensure that they reflect the business of banking today and provide clarity for the banking ecosystem of tomorrow. At a high level, our message is simple. Streamlining and improving regulations will create a durable regulatory environment that promotes organic growth, competition, and a safe and sound system. Clear, coherent, effective regulations give banks the clarity that they need to plan, to lend, and serve their communities. With this in mind, there are a few topics that we'd like to raise. I'll start with capital. The recent expanded risk-based and standardized capital proposals signal a meaningful effort to improve risk sensitivity, reduce unnecessary complexity, and better align capital requirements with true risk. The streamlined approach that agencies have taken in the recent proposals are welcome and will help ensure that capital requirements are tailored to an institution's size, scope, and risk based on activities. We will continue to digest the proposals, it's just been a week, and seek to provide formal comments, but please note that finality is needed to truly provide clarity. We appreciate the tremendous amount of work that went into the proposals, and we encourage you to finalize and implement these swiftly so that banks are better positioned to do what we do best, lend to American consumers and households. Secondly, we'd like to emphasize the need for continual tailoring and indexing on an ongoing basis so that our regulatory frameworks evolve with the economy. Indexing key thresholds preserve the intent of tailoring, reduce cliff effects, and promote stability and predictability in supervision. Importantly, this is the kind of automatic adjustment that reduces the need for repeated rulemakings, which benefit both regulators and the institutions they supervise. Thirdly, transition and compliance periods matter. When banks move into new regulatory categories or become subject to incremental requirements, abrupt transitions can create cliff effects that are disconnected from changes in underlying risk profiles. Or worse, they can disincentivize organic growth. Reasonable phase-ins and extended compliance periods allow banks to adjust in an orderly way without constraining lending or forcing preemptive balance sheet actions that may not be economically efficient. We appreciate the recognition of these impacts and the 5-year transition period of AOCI in the recent proposals. Smoothing transition periods is an area where modest changes can have an outsized practical impact, and we look forward to continuing this important discussion. Fourth, and finally, while capital regulations and tailoring and indexing are key priorities for any bank, we encourage the agencies to continue to carry out the spirit of the EGRPRA review and look to older regulations like Reg K or even merchant banking, and seek comment on adjustments that should be contemplated in light of changes to the market and the broader financial ecosystem. To close, we want to emphasize that large regional banks are strong, resilient, and committed to supporting the real economy. We share our regulators' objectives of a safe and sound banking system and believe that streamlining regulation enforces this objective. Thank you, and I look forward to the discussion today.
Thank you. Thank you, Amber. Jamie, turn it over to you.
All right. Thank you so much, and good afternoon, everyone. My name is Jamie Woodwell. I'm the Senior Vice President of Commercial Real Estate Policy and Member Engagement at the Mortgage Bankers Association. MBA is a national trade organization representing depositories, insurance companies, security firms, independent mortgage banks, servicers, and others in the real estate finance industry. As background, I've been with MBA for more than 20 years through a variety of different markets. Prior to my current role overseeing our policy and member engagement related to the $5 trillion commercial real estate industry, I built out our research activities on those markets. Before MBA, I worked at Fannie Mae, at a technology company, Capital Thinking, a mortgage banking firm, the WMF Group, and a variety of other companies in commercial real estate industry. And through that time, I've worked with banks and other players navigating significant market changes, from the great financial crisis to the emergence of private capital, COVID, to more recently a shift from lower interest rates to higher interest rates. And through those periods, we've seen incredibly positive developments have occurred in the market. These include advancements in modeling capabilities, massive change in the amount of data and analytical information available, increasing due diligence, and greater experience underwriting and working with borrowers. As background, I think it's important to reinforce a few key points about commercial real estate and commercial real estate finance. First, Banks are incredibly important to commercial real estate. Banks account for 38% of the 1.5 trillion, or the, 38% of the $5 trillion of commercial mortgage debt outstanding, the largest share of any capital source. Second, commercial real estate is incredibly important to banks. Commercial real estate loans have been a large, consistent, and valuable asset for banks with both established income and well understood and accessible capital behind them. It's important to note that during the Great Financial Crisis, loans backed by income-producing commercial real estate properties were among the best performing loans on banks' balance sheets. Third, an inefficient regulatory environment can keep banks from playing their appropriate role in investing in their communities through commercial real estate. One note, when I speak of commercial real estate lending, I'm referring to loans backed by income-producing properties. These are the properties with leases, rents, net operating incomes, cap rates, and the like, and are largely distinct from loans backed by owner-occupied properties. You end up with a range of property types in this sector, from shopping centers to office buildings to warehouses and apartment buildings. These are in large and small markets and loan amounts from hundreds of thousands of dollars to hundreds of millions of dollars. Let me start off with outdated regulation. Right off the bat, I'd like to commend the Fed and the other regulators for addressing what many of our members consider the most significant of outdated regulations: bank capital requirements and the Community Reinvestment Act. On capital requirements, we thank you for the just released proposals. We and our members are working through them and look forward to providing our feedback as quickly as possible. And we're particularly interested in your proposals around risk weights for commercial mortgage loans, including multifamily, and ensuring that elements like the unworkable cross-default provision from the 2023 proposal are addressed. So we thank you for addressing that, removing that from the latest proposal. Getting these capital levels right will be incredibly important to the market and to the role that banks play in commercial real estate. So we look forward to working with you and with others to make sure that they are. The Community Reinvestment Act is another area of significant potential impact. We hope this is an area where you reconsider existing regulations, and we look forward to working with the agencies. As one example of something we've consistently heard that could have a big impact is quarterly publication of a list detailing activities that are eligible for CRA credit. Eliminating this uncertainty would allow banks to lean in on lending, matching those examples, leading to increased community impact. One of the topics I know you're considering through this panel and your work is outdated thresholds. There I'd point in the commercial real estate context to the concentrations in commercial real estate lending, sound risk management practices, and the elevated attention to banks with CRE equal to 300% of total risk-based capital. When that guidance first came out, regulators explicitly stated the agencies have revised the proposal to clarify that financial institutions play a vital role in providing credit for commercial real estate activity, and to make clear that the guidance does not establish a limit on an institution's CRE lending activity. As time has passed, the regulatory attention that comes with the 300% limit has become a deterrent to breaking that threshold. We appreciate the attention to risks that concentration in CRE or other activities may bring, but also recognize that thresholds that bring additional oversight can morph into de facto barriers. As a last point, I'd like to address reporting. In 2023, the agencies reiterated their policy statement on prudent commercial real estate loan accommodations and workouts. The original statement in 2009 was an important communication from regulators to banks to help make sure institutions were not making imprudent business decisions in order to meet regulatory and reporting requirements. It's a great example of healthy communication between the agencies and depositories. Performance to plan is an important corollary. In times of transition, such as those we've recently been going through, loans should be evaluated on their current standing as opposed to an outdated plan from a previous period. In a nutshell, modified performing loans shouldn't face additional scrutiny. Finally, I'd note that a lack of simplicity and materiality continues to be a major challenge in the regulatory reporting landscape, with firms spending significant time, resources, and effort, particularly on the FRY 14 reporting. Simplifying and modestly loosening certain requirements without compromising the Fed's ability to assess institutional risk would meaningfully reduce frustration and the need for high staffing levels to produce accurate reporting. We'd look forward to and welcome further discussion with staff to help ease the burden while still meeting the Fed's needs. In closing, again, as mentioned by a number of people, thank you for the opportunity to be here today. And if I or anyone at MBA can be of help, we are ready, willing, and able to do so. Thank you.
Great. Thank you, Jamie. Nicholas, we can see you on the screen, so I'm going to turn it over to you.
Thank you. Do you hear me?
Yes.
Okay, thanks very much. It's an honor to participate in this session. Also, very many thanks for the opportunity to participate remotely, as I couldn't make it in person to Washington, D.C. today. My perspective is as an independent analyst of banking and financial sector policy at the global level, but also in individual jurisdictions. As you know, I work at the Peterson Institute for International Economics in Washington, D.C., but also at Bruegel in Brussels, which is a similar organization focused on Europe. I have to apologize for the fact that I'm not as familiar with some of the details of U.S. banking and financial regulation as other panelists. My work is mostly focused on the international level and on Europe as a jurisdiction with a comparative perspective. I'll do my best, but I may stumble with some of the acronyms. And let me mention also that I've been for a long time an independent non-executive board member of the trade repository arm of DTCC. I don't think that creates a conflict here or colors my point of view. I'm not speaking in that capacity, but that's an appropriate disclosure to make. I think it's very healthy for agencies like the Federal Reserve to regularly review prudential requirements and the prudential framework to seek opportunities for simplification. As has been said by others, there's a risk of accretion of increasingly obsolete regulation, so this exercise is good. At the same time, it has to be managed very cautiously in order to not throw the proverbial baby with the proverbial bathwater. In this respect, I will observe that in my analysis, crisis of March 2023, including but not limited to Silicon Valley Bank, has been a failure of both supervision and regulation. One particular aspect from the international perspective, which I emphasize in this intervention, is the fact that Silicon Valley Bank was not considered a large internationally active bank and therefore not subject to the Basel framework. Well, on the face of it, Silicon Valley Bank was large. It was in the top 20 banks in the US. It was internationally active. It had an important subsidiary in the UK. So from a very layperson's reading of the Basel framework, it is debatable whether the fact that it wasn't considered fit for the Basel framework was appropriate. We can debate, of course, at length if a Basel implementation on Silicon Valley Bank would have made a difference. I think it would. Overall, the risk climate is deteriorating, and there is an increase in the perception and I think reality of systemic risk. Part of that is geopolitical. I don't think I have to elaborate a lot on this, but the environment is not improving. It's deteriorating very fast, including for the US. Part of this is a froze in some market segments. Of course, private credit comes to mind. It's not the only one. I think we have seen lots of volatility and arguably pretty exuberant valuations in a number of market segments that should call the attention of policymakers. And frankly, part of it is the erosion of institutional strength, which we see in a number of jurisdictions, including arguably the United States. So this is not a good moment to reduce prudential requirements. It is certainly a good moment, as every moment is, to seek simplification, but those two objectives are arguably very different and should be differentiated in the policy process. Let me conclude with Basel and the relationship of the US with other jurisdictions within the Basel framework, therefore not commenting at all on how the proposals may affect community banks. I think Basel compliance in historical perspective has been pretty good in the US. The US has been among the most compliant jurisdictions, both in general and in the details with Basel, with the exception I mentioned of possibly a too narrow scope that didn't extend to all large internationally active banks. This Basel compliance, including with Basel III in its initial steps, has been good for the US banking sector. It has been very positive in terms of investor perceptions, in terms of competition. And I think it is very important for the US to keep complying with the Basel framework, including for things like the leverage ratios, the inclusion of sovereign debt exposures, for example, in the leverage ratio, I think is important both in its own right and also to show that the US is exemplary in its compliance in Basel. Conversely, a departure from that would have negative spillovers on the rest of the world. I think it's also been good for the US banking sector that there were additional requirements that for GSIBs went beyond strict compliance with Basel requirements, and I think that has served the US banking sector well, including the GSIBs, which have gained market share internationally during that period. Here, I think the reduction of the enhanced supplementary leverage ratio that was announced last year may be debated as to its consequences. Finally, we know that the US has not been very prominent in applying the second pillar of the Basel framework, Pillar 2 on supervisory review. There are deep structural reasons for that, but I think Pillar 2 has been very useful, would have been useful with Silicon Valley Bank. It has been useful in other jurisdictions, and maybe it's a case to review that US feature. Thank you very much, and thanks again for the honor to participate here.
Thank you, Nicholas. We appreciate that. Thanks to all the panelists for providing your opening statements. I thought maybe I'd ask a couple questions, and then I'll also give you some opportunity if there are things that you didn't get a chance to put on the table. One thing that most of you mentioned in your discussion was most all of you talked about thresholds or indexing. That was an important component from all of you all, but I think everybody just sort of touched on it. So I wanted to see if people wanted to elaborate a little more on this topic, since it seemed to be such a one that was prevalent across most of you. So Tyler, you want to start?
Yeah, sure. I'll go ahead and start. So the vast majority of asset thresholds facing the banking sector are static in nature, and many of these thresholds were established decades ago. And as my fellow panelists flagged in their remarks earlier, when you have static thresholds that haven't been changed in decades, it creates three kind of primary issues. One, you're going to capture institutions that were never intended to be captured by various rules and requirements. When they were designed in the early to mid 90s, a complex large bank looked different than a complex large bank in 2026. Because of that, you're going to discourage organic growth. We meet with our members at the ABA all the time, and one of our common things is we ask folks to raise their hand how many folks have had to kind of double think crossing a regulatory threshold or a statutory threshold because of the increased burden, managing below that threshold, or alternatively contemplating a merger or acquisition so that they can achieve sufficient scale to comply with the new burdens associated with that threshold. So you're going to discourage organic growth. And then finally, it also dilutes regulatory resources. So when we're thinking about prioritizing regulatory resources where the most risk lies, if we're not revisiting these thresholds, you're going to be spreading supervisors much more thinly than you need to be doing so if you're focusing on much smaller, not very complex institutions. So the solution seems pretty straightforward in our view, which is to adjust these thresholds for past inaction and index them going forward. There's currently, an active discussion about within indexing, what's the best metric. We were very thankful for the FDIC taking the lead here on their proposal for Part 363. We were encouraged to see indexing incorporated in the recent Basel proposal, the GSIB surcharge proposal, and the the new standardized approach proposal. The GSIB surcharge proposal looks at GDP. The FDIC proposal and the other two capital proposals look at CPI. At ABA, we agree with some of the sentiments that were expressed by Governor Waller at the recent board meeting. We think GDP makes a lot more sense when it comes to thinking about banks' asset thresholds. Looking at price levels, in isolation doesn't track as well with the role that banks play in the economy. Banks support economic growth. One of the points he was talking about, Governor Waller, is that, GDP incorporates not just price level, but growth of quantities of goods and services in the economy. And banks support both of those functions. As price level increases, more deposits come in as household incomes grow, but they're also financing lending for the production of goods and services. So it tracks much more closely over time with the growth of the economy rather than strictly price levels. So I'll pause there and kind of let the other panelists speak on it.
Sure. Who wants to, Sanjay, you want to go next?
Oh, here we go. Just to add on this, maybe a threshold that naturally not a lot of people think about, my colleague has done a lot of nice work on this, which is the $10,000 currency transaction report trigger set that was set in the early 1970s. At current dollars, this would be more than $70,000. This generates massive reporting volume. It has pretty limited law enforcement value. Only 5% of all these reports are actually being accessed by law enforcement. So just thinking about how to maybe index that and bring it up to current levels could already remove a lot of the burden just for reports that basically create a lot of paperwork but don't seem to have the benefits that originally were envisioned because it's been a couple of decades since these were set.
Thank you. We also agree with Governor Waller's comments regarding GDP and think that this is the best marker for indexing so that growth will be a reflection of the market. And as banks seek to serve and function in the market, we think that that is a good metric to right-size the regulatory environment to reflect the larger system. When we think about indexing, we really, taking a step back, size was never meant to be a dispositive factor of regulation. You have a host of things that, the law asks for regulators to take into consideration. And it's an impossible task to set categories based off of anything but size almost. And so we're sympathetic to this size marker, but we think that this should be a durable living size marker so that this grows with the economy, so that it adjusts over time, and so that you don't wind up in this situation where banks are confronting a threshold and they're potentially choosing to, as Tyler mentioned, either not grow or pursue a merger to grow so that they can digest the costs that come with the increased burden of crossing categories. We think that as the Fed and others consider these, please look at thresholds across the board. We think that this is prudent. It will make sure that our regulatory system is living and durable, and especially for the Fed, as you contemplate potentially the tailoring categories 1 through 4 set by the 2019 tailoring rule, to think about how the institutions that were captured, even in 2019, how much the market has changed over the past not even decade. And so if we're able to right-size these thresholds and index them on a going forward basis, that will make this system more durable. It will give banks clarity. It will hopefully lift some of the burden on continually having to think about this from a regulator perspective and be good for the system.
Great, thank you. Jamie, did you want to get in?
Yeah, I guess ditto. So much has been said so well so far. And I just reiterate the cliff effect that I think a number of people have mentioned there. And Amber had mentioned the transition and compliance periods as a way to try to smooth that, and any other ways so that there isn't quite the cliff, but a way to make it easier to transition up into and through some of those impacts.
Thank you. Nicholas, did you want to get in? I want to make sure I give you an opportunity on some of these.
No comment on this one. Thank you.
Okay.
Just add one more thing
Sure,
on
go ahead.
indexing. So just one small example of the importance of kind of interagency coordination for indexing to the point of trying to kind of approach this from as holistic a perspective as possible. We've heard from members that, the Part 363 proposal that the FDIC finalized, that provides benefits at the IDI level, but there are similar auditing requirements that are Fed requirements for holding companies that also start at $500 million, such as the FRY6 annual report of holding companies. So just a small example of how interagency coordination can ensure that there's consistent treatment and a consistent approach. And that's just a small example that I think is representative of a whole host of other thresholds where interagency coordination is going to be key.
That's great. Thank you. Yes, there are a lot of thresholds. let's go back just for a minute, because I know a couple people probably didn't maybe get as much time, or maybe there are other items that you want to put on the table that you didn't get to expand upon. So let me not lead the conversation, let you all lead. Are there other topics that anyone wanted to raise or put on the table that you didn't get an opportunity to in the opening remarks?
I think, great, it's on now. Thank you, Mary. So I alluded to these briefly at the end, but in the spirit of the EGRPRA review, and kind of in reference to my colleagues on the panel's remarks and the panel before, there is an expansive suite of regulations that banks face, and they face many regulations from different regulators. And so I would encourage, to the extent possible, and I know that this is incredibly difficult, but to work together in the interagency process to streamline where possible so that banks have the same standard across the board. One example that hasn't come up yet, and we're very appreciative of the regulators' work in this space, but are on the outstanding rep risk proposals. There are slight differences in these proposals, and so if there is a way for the three agencies to come together and finalize in a manner that is consistent, I think that provides banks clarity. But that's just one principle, and that carries across the waterfront of regulations. Additionally, we really appreciate, and Sanjay, I think maybe you said it earlier that, or maybe Tyler, it was you, about the 10-year review of EGRPRA, and maybe that should be condensed. So one example, I know that there have been FAQs released, not too past future on Reg K, for example, but I think, if we were to really take as an industry a look at this, the landscape is changing, and so how should we think about this? I think this is one example where notice and comment would be helpful, discussion would be helpful, to take views across the industry. And then the last kind of nugget that I threw in my open remarks, to merchant banking, there's always competition in the financial ecosystem. And I think, we see it now more than we see it ever between banks and non-banks. And so if the agencies are able to consider, especially the Fed merchant banking and the authorities there, and how we should think about this and the evolving and dynamic landscape, I imagine you would receive many comments and they'd be worth consideration. So thank you.
Thanks. I might build also on some comments that were made on the last panel, as well as something I mentioned was, so the call reports on the last panel, the FRY 14 by me, and that opening up the EGRPRA process every 10 years, lots of good information coming in. Hopefully the top doesn't just get closed at the end of the process, but that those things that are brought up, they're worked through. Obviously, not everything can be done immediately, but there's so much that can be improved. And I know that everyone on the panel, this panel, other panels, is ready, willing, and able to help to identify ways that that the Fed and other regulators can continue to meet their mandates while also stripping away some of those things that have calcified over the years and has built up and may not be really adding the value that it could be.
Great, thank you. Nicholas, is there anything I want to make sure I give you an opportunity? Anything you want to respond to that you've heard, or anything additional you would like to add?
No, I think this is a very useful hearing. Again, my perspective is primarily international. The world is looking at the U.S. There's no question about that. It's a permanent feature, and there will be international implications of the decisions that are made in this country.
Great, thank you. I know I'm getting signals that we're down to the last little bit here. Any final comments that anyone would like to put on the table? Sure, go ahead, Sanjay. Let you be the last comment.
I think as the regulators engage in this review, one thing to keep in mind is really kind of like to categorize the different actions that can be taken according to the ease and the time it would take to change it, right? And so we have the process changes, the regulatory changes, and the statutory changes. And so really trying to look at the low-hanging fruit something that can be through adjustments of existing processes or harmonization across different agencies, which doesn't require the very lengthy notice and comment period, or underlying statutory change, could really go a long way in helping with a few things. Just as an example, when you look at current payment processing times, right? Like current practice allows funds availability to take 1 to 5 days for many transactions. A proposed reform could require that payments under 5,000 post within 1 hour, and this could be done using existing infrastructure, for instance, through instant payment rails, without having new compliance burdens on banks. And so these are examples where when you look at potential process reforms, one could go for the lower hanging fruit than like the longer regulation reforms that take more work.
Great, thank you. And I think that's all we have time for on this panel. I want to thank all my panelists. I really appreciate your time and your thoughtful comments today. So thank you very much.